Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement, and along with us, helping to guide us through this complex financial world, he is president and founder of TJ Stearns Inc., Chicagoland's CFP certified financial planner, Tim Stearns, with us. Tim, welcome back in.
Peter, thanks for having me.
Always a pleasure, Tim. And with the St. Patrick's Day holiday right around the corner, coming up Wednesday, the 17th, next week, midweek. So I don't know how much of a celebration, plus with everything else going on in the world, but we'll talk a little bit about it today in the perspective that it is a holiday that is in some part based around luck. And a lot of Americans are also in some part basing their financial futures around luck. And Tim, is this really the right approach? Do we want to be more good than lucky? Do we want to form habits and disciplines rather than relying on luck? We'll talk about that on today's program, as well as cover several financial myths. More than the myth of the pot of gold at the end of the rainbow, these are ones that your retirement may actually be based on. Are you comfortable basing your retirement on these? So Tim, I think a great program today with the holiday right around the corner, and it should be fun.
I agree. And I'm half Irish. So, my dad was 100%, but anyway, a lot of people talk about how, some people are lucky and some people, if I didn't have luck, if it wasn't for bad luck, I wouldn't have luck at all. Yeah. What I find is that, preparation leads to luck. And I think that you have to have a plan. And, we beat that into the ground here, but it's true. I think these are not things that we do, here. We work in the know, and we want to make sure that our clients, when we do an income allocation plan, protect and grow plan, whatever you want to call it, we're making sure that, they are going to have luck, but it's because we prepared them for retirement.
Well, there are a lot of sayings and cliches about luck, but the one that you mentioned there, if it wasn't for bad luck, we'd have no luck at all. That is oftentimes, it seems, the way that life works out. But that's not the way that most people's plans are put together. Most, and air quotes here for folks listening on the radio, most financial plans are really just hopes and projections and speculation and hypotheticals, Tim. And they are really kind of rose-colored glasses with what they are assuming will happen in the future, some steady rate of positive returns for the market all the way out until infinity, and the plan is actually reliant on that. And so another saying with luck, this one by Dirty Harry, you've got to ask yourself one question: do you feel lucky? And the way that many savers and investors treat their preparations for retirement, it certainly bears the question, well, do you? Because it seems like a lot of us do.
I don't know if there's anything in the world I'd want to go into just winging it, and I've used this analogy before. If I come to you and your wife's house, and then I say, I'm a builder and I want to build you your house. And you say, well, let's see the blueprints. I say, no, I'm just going to wing it. Well, people are literally doing that with their retirement plans. And I just don't get it, because most of these people that are retiring right now are of the age, like my brothers and sisters, that they're baby boomers. They haven't really had a pension. Pensions are few and far between nowadays. So those are the things that we try to help them see through, and people are forgetting, it's been a great bull run in the market, and I really appreciate that, but all good things come to an end. We saw that in March. There's a lot of people freaking out, and I still say, the Fed is printing money, inflation could be there, the Fed is printing money at a alarming rate, and literally propping this market up. And I just don't see it sustaining itself for long. And you know what, I wouldn't go too deep into the market if I'm, in my 60s, because what it comes down to is that you're going to have, timing the market and timing your retirement are, kind of the same thing.
Well, Tim, and truth be told, that temporary blip in the market radar known as COVID, when it lost 30% and bounced right back up, that wasn't even a true cyclical market correction like what we are overdue for. That was simply a specific event that was unlike any other that resulted in the printing or digitization or creation of what, an additional $6 trillion in currency and debt. And with all of that new money with nothing to do with it, because we're all shut down, a lot of it was being invested. And so Econ 101, supply and demand, where there's a lot of demand, prices go up. So I think you're right that the market rebound in large part was due to a lot of printing of money and a lot of the additional debt and deficit that we took on. And so again, here, Tim, we've got to look at, do we want to base our retirement, our well-being, on just luck in timing? Or is it really better to be good than lucky? It's been said that it's the other way around. It's better to be lucky and good. But I think that most people who do have the outlook of confidence and success for their financial future, that they will be able to maintain that, have done so with habits and discipline and routines rather than just lucking into it. And Tim, in fact, there have been people who have won the lottery. There's a whole show. It's a series, how the lottery ruined my life. A lot of people are not. Yeah, they have not done the work and the habit and the discipline to know how to treat a large amount of money. They come into it. Professional athletes go broke all the time. Children who inherit a large amount of money all at once. A lot of times, Tim, that money end up blown very quickly.
100%. And, it worries me that I see people still using modern portfolio theory, which is literally 65 years old now. So we have people come in here and, I have a mix of stocks and bonds. Well, in most cases, the bonds haven't really done much. So the stocks have kind of eaten up the portfolio, and they're not even really using the modern portfolio theory. And let's explain that. If I'm 50 years old, I should have 50% in stocks and 50% in bonds. These people, we had a gentleman in here the other day, 87% in stocks. He's 62 years old and wants to retire in March. And I was like, do you have stop losses on any of this? No. What's a stop loss? So again, back to my point, winging it is not a thing in retirement.
Tim, we don't expect to eat one salad or go to the gym one time and be the picture of health, to be in good shape. But
it
would be nice. It'd be fantastic. But in all reality, we eat right, we exercise, we do those things our whole life. And then when we get elder in age, we turn and say to ourselves, I've been very lucky to remain healthy. And we'd be right. But we did all of the things, all of the necessary habits to help increase the odds, the probability that we would have that luck. Another analogy, keeping a car in good running condition, we know it takes some routines and maintenance. You got to fill it up with gas. You got to change the oil. You got to do regular tune-ups, tire rotations, all of those things to keep the car going. And then eventually the car hits 250,000, 300,000 miles. And we're like, wow, we've been really lucky that this car lasted this long. And we'd be right, but we were doing all of the things that it took to increase those odds. And so I think that in our financial life, Tim, are you seeing that that the discipline, the habits, and the routines are things that people are doing, or do we maybe need to address that part of determining our own luck into the future?
I think that you have to look at leading up to it, what you're doing. A lot of people are doing the target date funds at their 401ks, and that's not really something that is a silver bullet. When the market went down 2008, most classes went down, including all those. So those are things that scare me, because sequence of returns risk is something a lot of people don't know about. When I'm teaching a retirement class and I ask that, does anyone know what sequence of returns risk? I've had probably 3 people get it right. And the rest just looked at me like, what are you talking about? And sequence of returns risk is real simple. If you retire into a bull market, the chances are you're going to have a darn good retirement. If you retire into a down market, chances are, you could run out of money. And again, I'm going to go back to the fact that most of these baby boomers, all they've ever known was a 401k. Their careers started at 73, which is when it came out. And, they worked for a while with a pension and it's frozen now. Well, now what, So, it's all about income. And that's why we do the income allocation. It's a retirement plan.
Well, if you would like to take the luck or timing out of your plan for retirement, if you would like a protect and grow plan and the help and assistance of a certified financial planner in putting that plan together, also helping you identify if your financial future is based on common myths or misconceptions, pick up the phone, give Tim Stearns a call, 800-640-2256. That's 800-640-2256. He does, for listeners to the program, make the offer for a complimentary financial review, report, analysis, and putting together of a plan for you and with you. That Protect and Grow plan will give you a snapshot of where you are currently, a clear picture of where you are in your financial progress after a discussion and conversation about your future goals, defining those, writing them down. Tim will put together a timeline of action items, steps that you can take in order to make those dreams reality, make those goals come true. Pick up the phone if you would like that plan. Simple, easy to understand language, simple to follow steps, things that you can actually work and achieve through the planning process. Tim will put that together for you and help you to implement that if you find that it will produce measurable benefits for you. And I believe after that process, you will see how having a plan does provide measurable benefits, removing the luck, identifying the myths and misconceptions, identifying those, taking them out of the picture, giving you more certainty and stability in your financial future. 800-640-2256 is the number to call. 800-640-2256. 800-640-2256. Call now for that Protect and Grow plan. Get that in your hands. Then work the plan and achieve those financial goals that are important to you. 800-640-2256. And Tim, you did mention income allocation. That is, by the way, referencing a book that is being used across the country as the resource guide, as the how-to manual for how to retire in today's economic world, how to create a more steady, stable, secure, reliable retirement. Income allocation is being used by financial advisors to help teach clients how to structure that retirement plan. And you make an offer for that book. If savers and investors would like to get that in their hands, they can do that on today's program as well.
Yeah, I'd like to say that anyone with over $500,000 worth of assets to give us a call and we'll get the book into your hands. We have digital copies as well as paper book copies. The other thing I wanted to say is that we are maybe fingers crossed we're going to ramp up to some retirement classes this June. We have some tentative dates at Roosevelt College as well as Harper College, which isn't too far from the highways, which is nice. That class has been great. Even my brothers thought it was that I sounded smart in it. So, I'm the youngest by 18 and 17 years there. So
the siblings are the toughest critic, especially for the younger sibling. Yeah.
Yes. Yep. I live it. So no, but I just think that that's a great, resource, and I can also do Zooms right now. If you're getting ready to retire, you got to get a plan together, and, we can do a Zoom and I can go over all the retirement stuff that we do with people in the class. We cover Medicare, Social Security, you name it. I think it's been really helpful for a lot of people, and people have referred a lot of people to us because of that, which is nice.
Well, again, if you would like that plan, the Protect and Grow plan, put together with the help and assistance of a CFP, a certified financial planner, no cost, no obligation for the plan itself. And then Tim and you can discuss implementation of that plan. Or if you would like the book, Income Allocation, call now, 800-640-2256. That's 800-640-2256. And Tim, really any financial professional is going to tell you that you cannot accurately time the market 100% of the time. However, that makes it virtually impossible to know when to time our retirement if the assets are in the market, correct? And it seems like a paradox there that we don't just want to end up on the wrong side of luck. in your planning process, in the Protect and Grow plan, you sort of take an angle on luck like it's Murphy's Law, that what can go wrong will go wrong. And when we plan with that perspective, we are more prepared just in case those things happen to us in real life.
Well, I mean, we're not doom and gloom here, but we're also realists that, you know, the market could go down right as you retire. How are you going to, you know, if your withdrawal rate was going to be 4%, that was a thing in the 90s, that it, you know, fails over 70% of the time now. You know, if that was your plan and the market goes down 30% like it did in 2008, actually 36%, you know, you're taking out way more than 4%. And, you know, when the money's out of the market like that, it doesn't grow back as fast, right? Because you don't have as many assets. So those are the things that we're looking at trying to do. You know, for people, and try to get a, you know, a reality check, because people are so bullish still right now. And I don't get it. You know, the pandemic is still going on. You have unemployment at high levels. You know, the only reason that I think that this market's up is because of the Fed, and, you know, it's smoke and mirrors to me.
Well, again, we don't want to base our financial future on luck or luck alone. Pick up the phone, give Tim Stearns a call. He is willing to help you put a plan together based more in reality and where assumptions are being made, carefully examining those. Can we rely on them? That's the question that you must ask yourself in the planning process. Again, Tim will help you identify where those assumptions, where those financial myths may be lurking in your plan. Pick up the phone, give a call, 800-640-2256, 800-640-2256. And Tim, you've got 7 common financial myths. And this is not that we're going to find a pot of gold at the end of the rainbow or that the lottery is my retirement plan. These are actually a lot of times what plans are based on. One of them is that the market always goes up, but we know that that's not the case, Tim.
Well, let's take, for example, if you retired in 2000, you know, the lost decade. If you watch that chart, you know, it went up, down, up, down, up, down, but it ended at the same spot. If you're counting on growth in retirement, it didn't happen there. Or you look in Japan, you know, interest rates, their market's been down for 30 years. So, and interest rates are at like 0 there. And that's kind of what we're doing right now in the United States. So that's a little scary to me. So the market doesn't always go up, you know, and if it stagnates, you know, I come back to sequence of returns risk. You know, if it stagnates your first couple of years out, that could be an issue. Worse yet, if it loses money and then you're pulling out money, you're taking out too much.
Yeah, again, these are risks that we run into retirement. And if we leave the money subjected to the ups and downs of the market, increasing the risk and the likelihood that we will see down markets and that we will have money disappear out of our accounts without having actually spent it, without having anything to show for it, Tim, that's a problem. And yet there are lots of, again, air quotes here for those just listening on radio, there are lots of plans that are based on these projections, that are based on the myth that the market will always go up. And we've heard that. But if the market always went up, would we hear the other saying, don't worry, the market always comes back? Well, if it's got to come back, where's it coming back from? And not only, Tim, is there the myth that the market always goes up, but there is also the myth of how much it goes up. Well, the market averages 10%. I guess the myth isn't the average. The myth is that that is a reliable outcome. And a lot of people's plans base that 10% rate of return, that probability, that hypothetical assumption, that is the basis of their financial future.
We don't ever do that. You know, I don't use the 10% rule. When I first got in the industry in 94, I saw guys using 12%, you know, so that's not a thing to me. I'll give you an example. Let's say one year I have a stock and I make 60%. The next year it goes down 50%. And then the final year, just 3 years we're going here, it goes up 20%. That's a 10% average, you know, and that's not something that we want to see people going through during retirement. You know, these high swings up and down, the volatility scares the heck out of me.
Well, 10% average. And yet, Tim, at the end of that period that averaged 10%, we have less money than we started with.
Right.
And a lot of people don't realize this. And I know that numbers are tough to translate over radio, but this is one of the fallacies. This is one of the financial myths that you need to identify in your plan. And the myth that there's been a 10% average rate of return, Tim, it also has led to people assuming that they can pull much higher cash flow out of their portfolio than what any kind of back testing or check in reality says is appropriate.
Exactly. That's a little scary to me. So you're getting into the 4% rule again. And I don't, a CFP out of California started that, Bill Bagna. He doesn't even use his own theory anymore, because it fails over 70% of the time. So, when we're putting in an income allocation plan, we're not relying on certain amounts to come out. We make sure that we can pay the bills, and that's what we want to do. That brings me to the next point. One of the fallacies, taxes will be low in retirement. I don't see that happening right now with what's going on in Washington, D.C., and not only that, but if they do, they're doing all these different stimulus packages, the taxes, someone's going to need to pay that bill at some point.
Well, this is the basis for the way a lot of Americans have saved for retirement, Tim. We can't deny that taxes have gone down since the 401k was incepted. I mean, back in 1984, if you were making $68,000, you were in the upper 30% tax bracket. Today, in order to get there, you've got to be making over $600,000. But this is about planning and looking ahead. It's not where we've come from and where we are today. It's where we are today and looking forward. I think we need to change the perspective, Tim, that taxes are going down in the future. Yet we have not completely changed that perspective. That's why a lot of Americans are deferring and delaying paying taxes on those retirement accounts. That's a decision that may surprise people with the consequences, may in fact come back to bite us if we do not consider the cost of that carefully.
Well, and that brings us to another idea, and that is to do Roth conversions. And luckily we have a CPA on staff here that can help with that. I always ask people, do you want to pay on the seed or the crop? And only in America will they let you defer $10,000 so that when you're retired and it's worth $100,000, they're going to tax you on it. That doesn't seem like a very fair, situation to me. The other thing is, a lot of people think they don't need life insurance in retirement. And that's one thing I really see a need for. They've talked about moving the estate tax down. If you remember, it's right now at about 11 million, and they're going to move it down in 2026 to 5.7. And then it's been bandied by Washington, D.C. that they might move it down all the way to 3 million. Well, I've met a lot of different clients that have over $3 million, including houses and that type of thing. It'd be nice to have some life insurance that can help pay off the estate tax, or that you can leave to your kids, tax benefit to them. There's no taxes on it, on the death benefit. And then lastly, a lot of people don't know long-term care, that there's components in some of these policies now that are outstanding. If you can't do 2 of your activities of daily life, they'll allow you to actually take money out of the policy, off the death benefit, and pay for that. So this is some of the things that we talk to people about. When I say we go to A to Z, we do. When I first started, I was just a stockbroker. All I did was stocks, but you got to be well-rounded to be a certified financial planner.
Well, if you would like the help and assistance, again, of a certified financial planner, a CFP, Tim Stearns is willing to help you. And putting that Protect and Grow plan together, no cost, no obligation, is a plan that you can refer back to, that you can exercise and execute the items that are listed. You can form those habits and disciplines and good routines to improve your outcome and your good luck odds into the future. That Protect and Grow plan, similar plans can easily go upwards of $1,000 to $2,000 for the time and the investment of a certified financial planner in crafting that plan and putting it together. Tim Stearns willing to do that with you and for you. No cost, no obligation. If you are willing to invest your time, he's willing to donate his to give you some guidance on what to do into your financial future, the steps to take, as well as putting that plan together and then discussing with you how to go about implementing that plan. 800-640-2256. That's 800-640-2256. And that book, Income Allocation, that's available to the first 10 callers with at least $500,000 saved for retirement. because every situation is different and some strategies work best for certain types of savers and investors. Some of the strategies are best suited for those who have taken planning seriously and saved upwards of $500,000. Now, the plan, the time, and the assistance, that's for anybody who's serious about their planning and their financial future. The book, that strategy is for those of you that have saved $500,000 or more for retirement. You need to understand these strategies to make the most of your money, to be efficient with it, to provide the stability throughout your retirement lifetime. Pick up the phone, give a call for either of those offers, though, if you are planning and you would like to achieve your goals in the near future. 800-640-2256. That's 800-640-2256. And Tim, another financial myth on your list here, dovetailing into that: never too little, never too much to plan, never too early to start planning, and never too late to plan either.
It seems like a lot of people procrastinate and then they get scared to go see somebody. And I've used this analogy a lot on this show. You know, I don't want to go see the doctor either, but once you leave there, you feel a little bit better that you got ahead of it and you weren't reacting to some ailment that you have. Well, if you run out of money in retirement, it's going to be too late. So why not get ahead of it and give us a call and see if we can help you and get an income allocation plan.
Well, again, if you would like to get that plan put together, the Protect and Grow plan, the income allocation book, pick up the phone now. Give certified financial planner Tim Stearns a call, 800-640-2256. That's 800-640-2256. St. Patrick's Day right around the corner. We sure hope that you have good luck into your future, but we'd rather base our financial future on knowledge and certainty rather than just luck alone. And that's what the planning process, ladies and gentlemen, is all about. Tim Stearns willing to help you with that. Pick up the phone, give him a call, 800-640-2256. Tim, we appreciate your time. Always a good time talking with you. Thank you very much for the guidance and perspective that you offer to Chicagoland area savers and investors.
It's my pleasure, Peter. Have a good one.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.